assume that international bank has a borrowing capacity of either 10 million US dollar or 70 million Mexican peso in the interbank market, depending on which currency it wants to borrow. Further, assume that 1 year has 360 days. So they want us to demonstrate how international bank could capitalize on its expectations without using deposited funds. Without using deposited funds, meaning that they have to go and borrow. Go and borrow. Now listen, this is a trick we have always used in Kenya to make some money. So like myself, what I do, whenever we approach a political elections year, what I'll do, I'll go, for example, to Mwasibu. Mwasibu Sacco is a great Sacco, quite a good Sacco. So for example, I'll borrow from Mwasibu Sacco, say 3 million Kenya shillings, and this is 2021, in 2021. So then what I'll do, I will straight away exchange this. I'll straight away buy dollars. I buy dollars, say at 115 Kenya shillings per dollar, And then now what I'll do, once I buy the dollars, what do I do? So in this case, I've borrowed Kenya shillings, I've exchanged, and in this case, I have now the dollars. So what I'll do is to, of course, in this case here, get a good person like a bank, a good institution like a bank. I give these dollars to the bank, right? So I'm lending these dollars to the bank at some rate. So what will happen? I will be getting interest as a decision which I took to invest the dollars. There's an interest I'll be getting. And then number two, there is what we call capital appreciation. Of course, in the political year, we expect our own currency to do what? To depreciate. Like right now, we are talking of 120 what year? You know, this one averagely will give me about $30,000. If it gives me $30,000, and then after say 6 months, each dollar appreciates by say 10 bob. I'll have made my cool Kenya shillings what year? 300,000 plus that ka interest kidogo na earn, nalipa mwasibu yake, nitabaki na kitu yangu kidogo. So anytime, ladies and gentlemen, you have an opportunity between making a choice between two currencies, we have a Kenya shillings, we have a US dollar. Always, you borrow the depreciating currency. You always, if you want to make some profit out of this, you always borrow the depreciating currency. So they started by telling us their part B, international bank expects that the Mexican peso will depreciate. So it means that this particular institution called International Bank will borrow the Mexican peso. So mention there that the bank, it's an institution by itself. The bank will borrow the Mexican will borrow, in this case here, the Mexican peso, since it is a depreciating currency. This is a rule. You always look at the two currencies that you have. Which one is a depreciating one? That is the one that you do what here? You borrow. Like in my case here, the Kenya shilling has been depreciating against the dollar, and we expect that to continue, right? So in short here, we are told international bank expects that the Mexican peso will depreciate against the US dollar from its spot rate of 0.15 to 0.14 in 10 days. The following interbank lending and borrowing rates exist. Assume that the international bank has a borrowing capacity of either 10 million US dollars, I'm not borrowing US dollars, or 70 million Mexican peso, I'm borrowing 70 million Mexican peso. So in this case here, in short, we are borrowing 70 million Mexican peso. We are borrowing 70 million Mexican peso. So what I'll do in this kind, because of the two currencies, I'll draw my table, normal table here. This is not the same as the money markets table. So you have told me to borrow, Mexican pesos. And there are how many being borrowed here? You remember we are borrowing today. We're not coming to borrow here. We are borrowing today. There are 70 million Mexican pesos. And then you convert to the other currency. Convert at what rate? At today's rate, convert at spot. Remember, for money markets, you're always used to putting this money. Here, in this question, we are told international bank expects that the Mexican peso will depreciate against the US dollar. We expect this depreciation to happen. So then what do? We borrow today. How much are we borrowing? We are borrowing 70 million US dollars. So this one we are borrowing today. We are borrowing today. Just like I gave you an example. I was thinking before political electioneering here, I knew that the shilling would do what it would depreciate. So what did I do that time? I borrowed 3 million Kenya shillings from Mwasibu Sacco, like that. So I borrowed that day. So in this case, you are borrowing today. Don't confuse this with money market question and you take this money here. We are borrowing 70 million Mexican pesos today, and then we convert. So is there somebody who can give me the today's conversion rate? Is there somebody who can give me the today's conversion rate? Is there somebody who can give me the today's conversion rate? Is there somebody who is able to see the today's conversion rate? 0.15, isn't it? So 0.15 is today's conversion rate. So convert at $0.15 per Mexican peso. So you convert, because they have told us the spot rate, today's rate is 0.15, and then in 10 days it will be 0.14. In 10 days, 0.15. Thank you very much. So could you kindly do your abracadabra and then you do the conversion here? So you're saying that $0.15 equals 1 Mexican peso. How about 70 million Mexican pesos? Could you kindly do, in this case, here, some abracadabra? You cross multiply. When you cross multiply, what figure are we able to get here, somebody? What figure are we able to get here, somebody, when you cross multiply? When you cross multiply, what figure are we able to get here, somebody? They are not talking to me. It is 10. Is it 10.5 or 105? 105 million. 105 million. Now they are US, what here? US dollars. So what do we do with this money? Of course, the rule is very clear. This is not money that you borrowed for anything else other than investing. You are lending this money to a bank. So invest the dollars. So invest here the dollars. So when we invest the dollars, I expect in 10 days this money to grow. So is there somebody who can give me the investing rate of the dollars from the table given? From the table given, I'm being given it is 10.5 million. It is 10.5 million. Thank you very much. 10.5 million, 10.5 million, 10.5 million, 10.5 million. Thank you very much. 10.5 million, whatever, 10.5 million, whatever. So I want to invest. So who is able to pick the investing rate of the dollar? The investing rate. Investing rate is the same as the lending rate of the dollar. Lending rate of the dollar is 8%. This 8% has to be prorated. This time around, we are prorating this in terms of number of days. Remember, this entire exercise, we are doing this entire exercise in 10 days. And they have told us here to take the there. There are 360 days. So 8% times 10 over 360 plus 1 like that. Could you kindly give me this figure? Could you kindly give me this figure? We shall overcome. Could you kindly give me this figure? Could you kindly give me this figure? 0.08 times 10 divided by 360. Remember, we are borrowing for only 10 days. We are borrowing for 10 days. Naomi says 1.00 something. Please try to give me many decimal places. Try to give me many decimal places. Try to give me many decimal places. 1.00 to like a 1, 2, 3, 4 decimal places all of us. 4 decimal places all of us. So then could you kindly give me this money down? What do you know about down movement? Down movement, what do we do? Down movement, what do we do? We always multiply, isn't it? Down, you take the 10.5 million down, it will become bigger. You multiply, you take 10.5 million times, please rub the 1.00 you have in your calculator there. I would want you to write it in 4 decimal places. So you say 10.5 times 1.0222. Is it out of 360 or 365? You know, you must work with what the examiner gives you. Further assume down there before required. Further assume that 1 year has 360 days. You can't question the examiner. 10,523, 10,523, 10,523, 100 US dollars like that. US dollars like that. Now, ladies and gentlemen, remember this money that you borrowed here, you're also going to pay interest on it. This money you borrowed here, you're going to pay interest on it. And this one you borrowed, this money from Mexico. This money from Mexico, it's a Mexican peso that you borrowed. Is there somebody who can be able to see the borrowing rate of a Mexican peso? Is there somebody who can see a borrowing rate of a Mexican peso? Borrowing rate of a Mexican peso. Borrowing rate of a Mexican peso, 8.7%. So we have here 8.7%, again times 10 over 360 plus 0. No, plus 1. Plus 1. Why are we adding this one? We are adding this one because of amount. Remember that formula of high school. Amount equals principal into 1 plus R, blah, 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 blah. But there is a 1 here, a 1 here. So the rate here prorated plus 1. So is there somebody who can give me this figure? Is there somebody who can give me this figure? According to Lily, we have 1.0024 like that. Right. So this concept of depreciating currency, appreciating currency, you have to be very careful with it. Don't treat it per se as a money market question, no. And actually the difference here is that here we are borrowing today. We are borrowing today. So could you kindly tell me this money borrowed today in 10 days takuwa what ngapi? Down again. Down. We are moving down. So 70 million times 1.0024 gives us what figure, ladies and gentlemen? Gives us what figure, ladies and gentlemen? Gives us what figure, ladies and gentlemen? This one here will give us what figure, ladies and gentlemen? This one here will give us what figure, ladies and gentlemen? Abracadabra. This times this. This times this. Gives me 701,68,000. 701,68,000 Mexican pesos. Mexican pesos. 771,68,000. 71,68,000. And the difference now between this and this is your profit. The difference between this and this is your profit. In short, my speculative profit here will be equal to you. My speculative profit will be equal to 771,68,000 Mexican peso minus 1052, 3,100 US dollars. So of course, ladies and gentlemen, there is no way you can subtract both of them. We'll need to change, we'll need to exchange. You can't really, they are not like terms. They're not like terms. They're not like terms. They're not like terms. So I would want to change. So it depends on what you want. You can decide to change Mexican pesos to dollars, right? So could you kindly change the Mexican? Remember, this transaction is coming to us in 10 days. In 10 days time, what is the exchange rate? What is the exchange rate in 10 days time? What is the exchange rate in 10 days time? Is there someone who is able to see in 10 days time what the exchange rate will be? What the exchange rate will be? It will be 0.14. It will be $0.14 per Mexican peso. Per Mexican peso. So unaweza ukaamua uchange ile ama whichever you want. Assuming you want to change this to dollars. So if you want a profit in terms of dollars, then we are saying here $0.14 equals 1 Mexican peso. How about these 71,68,000 Mexican pesos? How about this? Can somebody in this case here please cross multiply? Ndio tupatie profit in $C. Utupatie profit in $C. Utupatie profit in $C. So this one when you multiply, itakuwa ngapi profit in dollars? When you cross multiply this and this gives us what figure? They are not talking to me. I don't know why. They're saying it's 982. 982. They're saying it's 982. 998, 23, 250. Thank you very much. Minus 10, 52, 3,100. 3,100. 99. $98, 23, 98, 23, 200, 520, yeah? 520. So wanasema ni 60. Actually, I'm the one who did it wrongly. Remember, I'm the one who did this wrongly. Remember, this is the revenue part. This is the revenue. You know, this is the revenue. This is the loan part. This is the cost. It's supposed to be the other way around. It's supposed to be the other way around. Oh, yeah. Profit is revenue minus cost. It's supposed to be the other way around. Oh, yeah. inafaa ikuwe 1052 3100 US dollar minus 7016 8000 Mexican peso. Peso hii ni wrong hii. Ndio sasa answer final ikuje kuwe hiyo 699, ikuje kuwe 699 580. 699 580. That is the speculative what here? Speculative profit. That is a speculative profit. So what have you learned out of this class? What have you learned out of this question, ladies and gentlemen? What have we learned here? 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 What have we learned here very fast? What have we learned here very fast? What have they learned here very fast? What have they learned? What have they learned? They are not talking to me. Borrow depreciating currency. Borrow depreciating currency. Borrow depreciating currency. Always move from, start with the weaker currency. For us to see whether you guys have been able to learn something out of this important question, could we kindly try part C? Could we kindly try part C? Because you have done part 1 and the profits. You have already gotten the profits. How about part C? Assume all the information provided to be above, with this exception. International Bank expects the Mexican peso to appreciate from its present spot rate of that to that in 30 days. Now, this time round is that we have the Mexican peso appreciating. We have the Mexican peso appreciating. So if we have the Mexican peso appreciating, which currency do you think are we going to borrow this time round? Which currency shall we borrow this time round? Which currency shall we borrow this time round? Of course, if Mexican peso is appreciating, the other currency is depreciating. Thank you very much. So in this case, here mentioned there that the US dollar, if Mexican peso is appreciating, if Mexican peso is appreciating, then we have got what here, somebody. If the Mexican peso is appreciating, then the dollar must be depreciating. And ourselves ni kuchukua ile ambayo imechapa ile na depreciate ndio sisi tuna borrow, right? Therefore the company should borrow US dollars. Alafu unakuja unachora kimeza, hata kama ni kibaya unachora namna hii. Always mguu ya kwanza lazima ianze na borrow, na umesema ni borrow huu US dollar. Alafu utainvest the other currency. You invest the Mexican peso. Invest the Mexican peso. I see it's from up downwards here. Always up downwards. Downwards, always do what here? Multiply. Yeah. Umeshachora namna hii. Please, ladies here, ladies, I'm talking to you this afternoon. Don't use a ruler now here. Like in this class, we don't want you to use a ruler. It's freehand, so you can move with speed. I know we are always neat, but not on this one. This one is freehand, so you can move with speed. So once you are free, or rather you reached here, please put a thumbs up. Put a thumbs up, or just Y for yes. Yes, thank you very much. So then how much are we borrowing in terms of US dollars? How much are we borrowing in terms of US dollars? How much are we borrowing in terms of US dollars? Who is this saying 70 million? 70 Mexican peso. It's either you borrow 10 million US dollars or 70 million Mexican peso. We are borrowing 10 million now this time around. This time around, we are borrowing 10 million US dollars. 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 The only thing you guys haven't yet told me is if you're borrowing 10 million US dollars, at what rate? At what rate shall we be borrowing these 10 million US dollars? What is the rate of borrowing US dollars? The rate, interest rate borrowing. I hope you are able to see that annual borrowing column, 8.3%. So we have here 8.3%. It has to be prorated times 10 over 360 plus 1. What do we have, ladies and gentlemen, here? Equals abracadabra. Abracadabra, tupate hiyo max yetu kwanza, tuwe kwa mfuko hiyo max yetu kwanza. Abracadabra. Aha, only 30 days. Akusema every other thing is remaining constant. 30 days. Thank you very much. See you Omeka 30 days. 30 days. See you Omeka 30 days. You are very bright. 30 days. Thank you very much. Bright and keen. 30 days. 30 days. 30 days. Thank you very much, Alice, as well. 30 days. Abracadabra, then please come here and talk to me. So then what do we have here? 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 Abracadabra, what do we have here? Abracadabra. Wanasema ni 1.0069. 1.0069. Like that. Alafu sasa, unakuja hapo unasema today we are converting. What is the conversion rate that is given there today? Remember, this borrowing is today. You're borrowing here today. You're borrowing today. You're borrowing now. You're borrowing now. Are you able to see there? Yes. Today, ladies and gentlemen, we have the exchange rate being $0.15 per what year? Per Mexican peso. Per Mexican peso. So could you kindly then go ahead and exchange this? Exchange this very fast to Mexican pesos. Those are some low-hanging fruits. To Mexican pesos, to Mexican pesos, to Mexican pesos, to Mexican pesos, to Mexican pesos. What do we have here? To Mexican pesos, wanasema 1.5 million. Juliet, hata ukitumia J, Juliet, why not? Wanauliza why not? Kuna swali hapo wanauliza. Why not? Kuna swali wanauliza. Imepotea. Imepotea pole, I can't see it. Imepotea. So ni 66,666. Kama ile namba ya shetani ashindwe. Mexican peso, like that. Thank you very much. And now I want to invest the Mexican pesos. Could you kindly give me the rate of investing? The rate of investing. Anauliza, why not 0.17? Check there. Check there. You see, 0.15 is the today's rate. 30 days, we shall use 0.17. 30 days, we shall use 0.17. Today, we are using 0.15. So in this case, here, give me the investing rate of the Mexican peso. Investing rate of the Mexican peso, what do we have there? The Mexican peso investing rate, investing is sawa na lending. Mexican peso investing rate ni 8.5%. So abracadabra, 8.5% times 3 over 360 plus 1 new, which will end up giving us what figure? Somebody 4 decimal places, 4 decimal places, 4 decimal places, 4 decimal places. Wanasema itakuwa Naomi 100000071, like that. Alafu tunaanza abracadabra. Down, always you do what here, somebody? You multiply. Down, you multiply. Down, you multiply. Down. Tuanza na hii kwanza ya Anmungai. Tuanza na hii Anmungai anasema ni 67, 14,000. Anmungai anasema ni 67, 14,000 D. Mexican peso. Mexican peso 67. Na anasema ukweli. Sitaki kutumia ile figure kwa kalenda yako. Nataka uandike iko na 4 decimal places. Iko na 4 decimal places, ndio nataka kuwako. Ndio nataka kuwako. The one that has got 4 decimal places. 67, 140,000. 140,000. Thank you very much. Now from there, peleka ichin, 10,000 times is quite an easy one. We are multiplying. We are multiplying. We are multiplying. According to Glado, the 169,000. 169,000. And these are US dollar C, like that. And then now you go straight away and they give us the speculative profit. So profit always is revenue minus cost. So in this case here, my investing revenue, at the end of the day, I'll get this 67, 140,000, 140,000 Mexican peso minus the cost, which is what here? 10,069,000 US dollars. So now remember that this profit is coming to you after 30 days. The profit is coming to you after 30 days. After 30 days. So ulikuwa unauliza mbona tumile 0.17 after 30 days, the exchange rate will be 0.17 dollar per Mexican peso. Sasa able to change your profit jameni. To change profit jameni. So ukichange profit jamaneni itakuwa namna gani? Let us put this thing in dollars. Let's put this thing in dollars. We know the rate here. Tunajua rate ni 0.17 dollar equals 1 Mexican peso. How about this 140,000 Mexican peso? Is there somebody who is able to give us this profit majamaneni? Inakuja ngapi somebody? Not the profit, but this figure changed. Because you see, you can't subtract this and dollars. You need to change one. You need to change one. Hawa niongeleshe sana uye 10, 11, 413, 800. 11, 413, 800 minus 10,069,000 US dollars. See like that. Which will end up giving us what profit, ladies and gentlemen? $723,800 dollars. So, ladies and gentlemen, please ensure that this question does not confuse you with what you guys are really known under money markets. This is quite different because it is asking about what here? Speculative profits or arbitrage profits. When we have got a depreciating currency vis-a-vis what here? An appreciating currency. You don't have to get all the marks. The most important thing is that you will be able to do what? You will be able at least to pick some marks if they give us this kind of a question. Is there somebody who has got an idea that can make them now get a few marks? It doesn't have to be all of them. Just a few more, slightly over 50%, slightly over 50%. Okay, so from there, ladies and gentlemen, they want us to highlight two shortcomings of the Black-Scholes model. Highlight two shortcomings of the Black-Scholes model. Highlight two shortcomings. Two shortcomings of Black-Scholes. Unazijua yeyote kweli? Ni sawa na disadvantages, ni sawa na assumptions. Ni sawa na disadvantages, ni sawa na assumptions. Ni sawa na disadvantages, ni sawa na assumptions. Hiyo 134 imetoka wapi? Hiyo imetoka wapi 134? I don't know ni wapi. Ni wapi. Lakini tushamaliza hiyo story. After all, what has mwalimu said for this last class, I mean, we need to talk about low-hanging fruits. A good question there. How do we differentiate between money markets and this? You'll be able to know this, Manoti. In money market question, have you ever seen an examiner talking about appreciating currency? No. In this question, did you see them talking about, for example, Mr. So and so, Mr. Manotti expects to receive 30 million in US dollars in? Nothing like that. You'll be able to know. I believe so. You'll be able to know. Great. So in this case, ladies and gentlemen, remember, number one is the term Black-Scholes is only used in situations where it's a model for European options only. So the Bermudan options, the American options cannot be really evaluated using the Black-Scholes model. That's number one. Great. Number two, Remember from this D1 formula, if you can remember, ln equals, we have here the spot rate over excess. If you can remember this model here, you'll be able to, like now it assumes that risk-free rate is known in advance. Risk-free rate is known in advance, and will remain constant, and will remain constant. And this is a lie. We know in life, this risk-free rate can never be what here, can never be constant. Like now you can see situations where the current Kenya government really wants to borrow heavily, especially internally. What are they doing? They're increasing the constant. Again, ladies and gentlemen, just like you said here, you can never be 100% sure of the time to maturity. Somebody will get tired in between and would want to dispose their options, right? The concept of risk, the standard deviation being known in advance and will remain constant. I'm so sure you guys have gotten. I'm not audible. Are you able to hear Mwalimu? Are you able to hear Mwalimu? Are you able to hear Mwalimu? Are you able to hear Mwalimu now? Great. What happened? Sorry. So in this case here, we are saying from the formula here, we know that our D1 equals, if you remember our D1, spot price, excise price minus ETC, right? You can remember risk-free. You can remember we have the standard deviation here squared. We have the time to maturity all over. If you can remember from this formula, I'll be able to know quite a lot of things, right? So for example, the risk-free rate is assumed that it's known in advance, which is wrong, which is faulty, a bad assumption. We have the risk, which is standard deviation, is also known in advance. It's quite a big lie to say that you know the variations, because cash flows here will always keep on, in this case, here varying in a way that you never anticipated, right? The time to maturity is known in advance. ETC, I've already given you more than you asked for. Great. From there, ladies and gentlemen, they want us to talk about part A, explain how currency swaps could be used to hedge against foreign exchange operating exposure of a firm. Now, assuming we have got two firms here, we have the parent and we have a subsidiary. Now, this parent could be in Kenya here. The parent is in Kenya, which has worked so hard to acquire a subsidiary in the US. Now, assuming Kenya company wants to make another investment in the US. For example, they are in need of what here? US dollars 1 million. Right? And then also out of its own research here and there, the subsidiary wants, for example, to do some things here in Kenya. It's in the US, but they want to invest in Kenya, right? And for example, they want Kenya shillings what here? Kenya shillings 100 million, right? So you see, ladies and gentlemen, the two companies, first of all, they are related. And they get to know that, hey, you want US dollars, right? And because I'm in the US here, why can't I'm known at the US. Why can't I go to a bank here in the US and borrow on your behalf? So in short, this company subsidiary, which is in the US, will borrow 1 million US dollars. And then of course, this company, which is in Kenya, will borrow what here? So they are swapping obligations. They are exchanging what here? Obligations. They're exchanging obligations. So right there, very fast, ladies and gentlemen, that the term swap is used to describe a foreign exchange agreement. Is used to describe a foreign exchange agreement. Is used to describe a foreign exchange agreement. A foreign exchange agreement between two parties. A foreign exchange agreement between two parties to exchange to exchange, 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 given loan obligations, 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 denominated in different currencies, in different what year? Currencies, in different currencies. So in this case here, they shall exchange given loan obligations denominated in different what year? In different currencies. Of course, in this case, ladies and gentlemen, you can even draw this where we have the parent company, which is in Kenya here, and then we have the subsidiary company, in this case here, which is in the US, right? So we have this one, which is in Kenya, needs 1 million US dollars. And then this one needs, for example, 100 million Kenya shillings. Under the swap, you know, to swap is to exchange. You are exchanging obligations. You're exchanging obligations. So under swap arrangement, the sub, or rather the parent will borrow Kenya shillings 100 million on behalf of the subsidiary, which is based in the US, and of course, vice versa. So in this case here, we are seeing a situation where the parent company is based in Kenya. So what it shall do, because it knows that the sister company is based in the US, needs 100 million Kenya shillings, then the parent company will simply go and borrow on behalf of who? On behalf of the subsidiary. They'll go to Equity Bank here and borrow on behalf of the subsidiary. How much? Kenya shillings 100 million. So then how does this swap ensure that these individual companies make a gain? They make a gain out of this. Remember, the parent company is known in Kenya here. It can get better interest rate offers from Kenyan banks. As I mark your paper, the most important thing that I would want to see here, ladies and gentlemen, is this concept of swap. Swap, basically, we are making a reference to what here, where these two parties here can exchange their loan obligations, which are denominated in what here? Different currencies. The moment you mention this, and perhaps you can even draw something small, I'm sure you'll be able to get all the marks out of this, Great. Now, ladies and gentlemen, I would want us to capitalize still on this same concept here. Look at November 2019. Let's look at November 2019, question number 4A. Question number 4A. November 2019, question number 4A. Are we there? We say today we aren't wasting any time. Are we there? November 2019, question number 4A. Yangu ni ya kitambo. Hii ni revision kit yangu ni ya kitambo, sasa itakusumbua. November 2019, question number 4A. They wanted us to distinguish between the following terms as used in the context of derivatives market: currency option and the currency swap. What do you have to tell us about currency option? At least currency swap umeona. Yeah, where two parties are exchanging loan obligations, which are denominated in different currencies. Exchanging loan obligations denominated in different currencies. But when you talk of currency options, these are financial. They are financial instruments financial instruments that give the holder the right, but not an obligation. The right, but not an obligation. The right, but not an obligation to buy or sell, foreign currency. Remember this time round, the specified instrument is a foreign currency because of the currency options. So to buy or sell a foreign currency at what year? At some predetermined what year? Price. Can go ahead to mention about quantity, but the most important thing that I will pick here under currency options is that this is very important. It becomes an option if the holder has the right but not obliged, has the right but not an obligation to buy stroke sell a foreign currency at some predetermined what year? Price, known as the exercise price. Very, very important. Very, very important. Okay. So does this make sense to you? Does this make sense to you? Does this make sense to you? Does it make sense to you? Can you build on this now? Great. Thank you very much. From there, we have the interest rate what year? Swap. Interest rate swap. Interest rate swap. Interest rate swap. So if I'm the one doing this to make sense to my examiner, I know that one loan will be on a floating interest basis. A loan, can I just mention there, a loan, which is then you were changing this, which is on a floating interest basis is exchanged for a loan, which is on a fixed interest what year? On a fixed interest basis. Remember, we have got here basically, as long as you mention the words floating and what year? Fixed, we'll be able to pick, and of course the name exchange because of what year? Swap. Because of the name swap, exchange. Remember, ladies and gentlemen, there are those investors who would prefer their interest rates, the ones who are risk averse. They would prefer their interest rate here to be fixed. It's 10%, 10%. I don't want a situation where after some time, when the Central Bank of Kenya comes and says, now we are increasing the base lending rate, you start telling me, no, you borrowed at 10%, but now because the central bank has done whatever, now we're going to increase to 13%. There are people who prefer that. And there are people who would prefer, especially in economies that are recovering, there are people who would prefer their loans to be what year? On a floating rate basis. They gain that way. When it's on a floating rate basis, it means that if the economy is doing very well, and the central bank in this case here takes the rate, say, down to 14%, then the bank will call you, will tell you, hey, you come over here. Now we are taking your interest rate down to 14% because the government has given us this kind of an instruction, right? Which one do you think is better between the two from your end? Which one do you think is better? Are you better off in this case with a floating rate loan or a fixed loan rate? Which one is better? Which one is better? Which one is better? Especially, and I agree with you, especially in Kenya today, the rate of interest is really going up. So you'll be better off in this case here working with what here? A fixed rate. But if you are talking of strong economies that are really having the interest rates going down and down and down, then you will prefer a floating rate. We shall overcome. So the most important thing somebody is telling me to repeat there, umeskeji na swap. Angalia umeskeji na swap. Sasa hakuna time ya kurepeat sana. Swap unajua kwamba we are exchange, and what are we exchanging? We are exchanging between a loan which is on a floating interest rate basis here with a loan which is what here, somebody on a fixed interest basis. Well, as long as we mention these terms, hiyo maneno umemaliza. Now from there we have the interest rate what here, collar. That reminds me that today I don't have a shirt with a collar. Interest rate collars. Interest rate collars. So interest rate collar, these are derivatives. These are derivatives that provide a maximum interest rate to be charged to the holder of the instrument. So these are derivatives that provide a maximum. You know, collar is the highest collar, right? So it gives the maximum interest rate, in this case that will be charged to the holder. So what will happen? You will go to a bank, tell Equity Bank, I need, for example, 5 million Kenya shillings. So no worries. So we're giving this loan to you, in this case here, at what rate? Say 16%. Then you tell them, no, I would want a collar because I know how banks behave. I know there is no way you'll tell me that the 15% will be, I would want you to give me a collar that you will never surpass this amount. And they'll tell you, no problem, at this fees, of course, not for free. At this fees, then we give you a collar of what here, say 17%. That it doesn't matter how high interest rates in Kenya will rise. Then we shall give you, in this case, even if they rise to 29%, your maximum is what here is 17%. Which again reminds me that we have what we call interest rate what here, interest rate floors. Everything is like this. But now in this case, they give the holder, because floor is the lowest, they give the holder a minimum. So it basically specifies a minimum. A minimum interest rate payable, a minimum. So under the floor, we are defining the minimum interest. It can never go below this. So we want to protect ourselves. Remember, derivatives are about hedging. They're about what here? Hedging, minimizing risk. Is that description enough for you? Have you been able, the most important thing is to pick something, however small, which you can use in your Tuesday's class to talk about something there. Great. And then we have hedgers and speculators. Ladies and gentlemen, remember that hedgers try to reduce risks. They use derivatives to increase, or rather to reduce what here. To hedge is to protect yourself, to hedge. So using derivatives to reduce risks. But when you talk of speculation, here you would want to use what we call price differentials between two markets, for example, right? And I gave you a very good example here on speculation. For example, somebody knows big banana. In Kisii, in this case here, goes for what here? In Kisii, for example, goes for what here? 500 shillings. The same banana here could be going for about just a nearby market, maybe Nakuru. In this case here, this one here could be going for Nakuru. This one here could be going for in Nakuru. This one here could be going for example at 1,000, right? So if somebody is able to run with this banana, assuming there are no expenses, I don't know what kind of magic you'll use. If you're able to run with this bunch of bananas and take them to Nakuru and sell them at 1,000, then you have made a speculative profit. You've made a speculative what here? Profit. You've made a speculative profit, right? So in this case, you're not hedging any risk. You are only looking at a profit by exploiting price differentials in different markets, So you can mention there very fast that speculation involves making a profit Speculation involves making a profit, making a profit. Don't use bananas here. Don't use bananas here. Making a profit from a security's price change, from a security's price change, from a security's price change. Hedging is the reduction of risk. Hedging is the reduction of risk. Is the reduction of risk, stroke volatility, volatility associated with price change. Hedging is reduction of risk, stroke volatility associated with price change. So speculation is about making a profit. Ensure that the word profit is there in your description. And then hedging is about what you're reducing risk. Tuko pamoja kweli ama iko shida? Tuko pamoja. Great. Thank you very much. Ladies and gentlemen, I would want us to look at May 2015. May 2015, question number 5. 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 Once you get it, please salute by saying yes. May 2015, question number 5. Question number 5. Arbitrage, yes. And I would want to do this part C. And somebody asked in this case here a very good question. A very good question up there. Oh, not even a question. It's Lucy wants somebody to share. Great. You can just take a snapshot and then you share straight away. We don't have time to waste because I would want us to finish. I would want us to finish this very fast so they can specialize. We can start looking at AFR. I'm so sure most of you would want us to be talking about advanced financial reporting, isn't it? You have been provided with the following series of exchange rates for the US dollar and the Canadian dollar and the British pound. Assume that you have got dollars. Assume that you have dollars, $1 million in cash. Demonstrate how you could take advantage of these exchange rates to obtain an arbitrage profit. So I can see 3 currencies involved. This question gave so many students a problem, big problem. You see, number one, they're giving you their dollars 0.6 per Canadian dollar. And then by the side here, just to confuse students who are easily confused, they gave us Canadian dollar 1.6666 whatever a dollar. So many students never really got to appreciate the fact that this and this are the same. The two are the same. Actually, one is a reciprocal of the other. You see, like now here, we are saying that $1 equals 0.6. No. It's $1 Canadian, because per Canadian equals 0.6 US dollar. So how about in this case here, $1? So if you try to cross multiply here, $1 US will be equivalent to how many Canadian dollar? If you try, it will be 1 over 0.6. Could you kindly give me this answer? 1 divided by 0.6 gives me what figure? 1 divided by 0.6 gives me what figure? Somebody. You'll confirm that is the same. Now they're not giving me figures. Now they're tired. Now they're not giving me. It is the same, isn't it? So meaning that this column here, a good student ought to have come to this column and struck it off. It's irrelevant. It's hot air. This column here. Have you done that in your past paper? Have you been able to cross that out? Have you been able to cross that out? Have you been able to cross that out? It's hot air, yes. It's hot air. It's hot air. Thank you very much. So then what I'll do, because there are three currencies involved, So in this case here, because there are three currencies involved, what I'll do, I will go here and draw a triangle shape. If you ask your grade 2, 3 son, boy, they'll tell you there is triangle shape. Triangle. Triangle, three corners, three corners because of what here? So we have here 0.6. Unaandika dollar per what here? Dollar per what here? Dollar per Canadian dollar. This is US dollar, remember. So from there, we have the second currency, which is 1.25 dollar per pound. This is US dollar. Whenever they're silent, it's US dollar. From there, ladies and gentlemen, we have the third one, which is 2.5 Canadian dollar, 2.5 Canadian dollar per pound. Like that. All right. Now, ladies and gentlemen, how much do we have to invest? How much do we have to invest? How much time do we have to, not time, but somebody's confusing me there with time. The amount given for investment is $1 million. $1 million US dollars. So we have here $1 million US dollars to play around with. So remember, inakuanga swali ya bahati nasibu. Swali ya bahati nasibu. Right? So unajiuliza, with this $1 million US dollars, where should I begin? Which currency should I be able to buy first to be able to make a profit? Should I go with this $1 million US dollars? Can I go to Bank C, for example? Bank C, I'll be chased away. Why? Because they're only dealing with Canadian dollar and the pound. They don't have US dollar. So Bank C, I will be chased away. So it's either I go to this one has got US dollar and this one here has got US dollar. But the question is, which one should I try? Which one should I try first? Okay. Now, ladies and gentlemen, here, in this case here, let's start with B. We start with B. So we start with B. So corner B, in this case here, I.e. buy pounds. You buy pounds. You buy UK pounds. So when you buy UK pounds, what do we have? So what will happen, UK pounds, it is 1.25 US dollar equals 1 pound. How about 1 million? How about 1 million US dollar? How about 1 million US dollar? So how about this times this divided by 1.25? 1 million times 1 divided by 1.25. Mbesha shigana. Mbesha shigana. Wanasema 800,000. So here I'll get 800,000 pounds. I will get 800,000 pounds. And now once I get this 800,000 pounds, which bank will I run to? Which bank will I run to next? Which bank will I run to next with 800,000 pounds that I've been able to buy? Right? Of course, I can't go to pounds and not here. I'll go straight away to C. So go to Bank C. So Bank C, we are buying, in this case here, Canadian dollars. Buy Canadian dollars. You are buying Canadian dollars. So the rate is this. It is 2.5 Canadian dollar equals 1 sterling pound. How about 800,000 sterling pounds that I have here with me? So when I cross multiply, how much will I end up getting? 800,000 times 2.5. 800,000 times 2.5. How much am I getting? I'm being given that this one will be 800,000 times 2.5 will be 2 million. This will be 2 million Canadian dollars. Thank you very much. Now, of course, I've been able to go to B. I've been able to go to C. Now I go back to A. So go back to A, and now you buy what here? You buy US dollars. Because now I have Canadian dollars. Buy US dollars. Buy back US dollars. Or you sell. Doesn't matter here. So in this case here, we are at A. So at A, ladies and gentlemen, what do we have here, ladies and gentlemen? At A, we are saying 0.6 US dollar equals 1 Canadian dollar. How about, in this case here, how about 2 million? Are you sure? Are you sure with this? How about 2 million? How about 2 million? They are saying no. They are saying no. How about 2 million? How about 2 million? How about 2 million Canadian dollars? How about 2 million Canadian dollars? How about 2 million Canadian dollars? So 2 million Canadian dollars will end up giving me, if I cross multiply here, I'll end up getting 0.6 times 2 million, which will end up giving me 1.2 million US dollars. Hooray! Remember, I began with a million. Beginning amount, if you remember, beginning amount was 2 million, was 2 million US dollar. When you subtract in this case here, I mean 1 million US dollar. When you subtract, you'll be able to see an arbitrage profit. You'll be able to see an arbitrage profit of 200,000 US dollars. What do you imagine? You have only taken advantage of price differentials, speculation basically, to be able to get $200,000. $200,000 ni pesa mzuri sana, profit. 200,000 ni pesa mzuri sana. Hiyo watu ukipatia bwanako zawadi ya 200,000 kwa nyumba, unaongeza mapenzi kwa nyumba. Hiyo ni pesa mingi sana. Hiyo ni pesa mingi sana. Pesa mingi sana. Hiyo ni pesa mingi sana. We shall overcome. Now, what if, for example, you had begun with this 0.6 and then you realize that you are making a loss? No worries. You simply leave that and then you straight away tell the examiner, let me try. Must I mean, this is your spouse. Hata kama economy ni mbaya, unambariki tu, kwani iko shida gani? Hatuna maisha mbili. Maisha ni moja. They will not really mind. Great. I can see Madam Mercy there putting up her hand for so long. Mercy, are you able to ask your question by chats? Yeah, Consolata is asking a question there. Unaona tukitaka vizuri, hata usiende kuinvestigate hapa ati ni gani strong ni gani weak. Unakati hizi mbili, wewe enda kwa ile exchange rate ambayo maduong. Sema maduong. Maduong inamaanisha is a German word for big. You may think it's bigger, but at the end of the day kuna weakness. Go for maduong. Start from there. Like that. Great. Now, Anne wants me to define arbitrage profit. What will you tell Anne, somebody? We have already done that. Arbitrage profit, ladies and gentlemen, what have we said about it? You are basically taking advantage of what your price changes to make what your a profit. Price changes of securities to make a profit. And it will even be sweeter if you use your own what your own terminologies. Your own terminology in that question. Great. Yeah, it's recording. Great. We are recording. We're doing well. We're doing very well. Now, ladies and gentlemen, there is a question that I would want all of us really to look at. Kalenjin, yes. Great. And now you'll get Mercy herself at Ajiki Kale. Ajiki Kale, kimuuliza Kiptororut. Anajua kamnyama kweli, anaitwa Kiptororut. Akijua kweli. Hata Mercy mwenyewe hajui Kale hata. We shall overcome. No, this good question is running up. This good question is running up. Why is this good question right? This good question. Why is it running up? This good question should not run away. We shall overcome. When I retire at 50, I would really want to know so many local languages. I would want to know them. Niko na hiyo talent. Hata Wakikuyu wengi hapa, hakuna kitu kama hiyo. Ulisikia wapi? Hakuna. Iko. Hiyo iko. Iko. Great. Great. Sasa ndaipata sasa. Sasa ndio hii. May 2015, yes. May 2015, question number 4. May 2015, question number 4. May 2015, question number 4. Let me know whether we are there. May 2015, question number 4. May 2015, question number 4. Paul Macau, I owe Paul Macau quite a lot. Beetle, yes. Lilian likumbe wewe ni mkale. Wewe ni mkale kweli. We shall overcome. We shall overcome. Shuka Limited, yes. Shuka Limited. Lucy. Great. So do we have the question now? Yes. And if possible, I've even seen somebody sharing this thing on this particular WhatsApp chat. Hata share kwa WhatsApp, share all over. So I would want to start with part B. Shuka Limited, a company that manufactures mobile communication gadgets, intends to acquire Panda Limited, which is involved in developing communication and networking software. So I can see current share price. I can see number of issued shares. I can see equity beta. I can see asset beta. Even if I do not understand anything in advanced financial management, whenever you see market price per share and you are seeing no's, you multiply them. I mean, come and give us market capitalization. Give us capitalization, I mean. So here you are taking market price per share times number of ordinary shares. We have Shuka, we have a Panda. Shuka and Panda. So can somebody in this case here do this for me? So like for Shuka, the market price per share is 5.8. So for Shuka, it's 5.8 times 210. I don't want to write the millions. Can somebody give me the market capitalization for sugar? Market price per share times number of ordinary shares. Could you kindly do this? 5.8 times 210. I'm being given 1218. Thank you very much. Please go ahead and do the same for Panda. Panda, I can see the market capitalization, 2.4 times 200. Could you kindly give me this figure? 2.4 times 200. Please give me this figure for Panda. 480. Now, if I'm the one, ladies and gentlemen, doing this kind of an exam, after I get this market capitalization, I know that I'll use this. I can't even make a comment that Shuka is basically a bigger company. Shuka is a bigger company. I wonder it's acquiring Panda, which is a smaller company. In terms of weights, yes. Abdi, no, maneno. So in terms of weights, come and give us weights here. So weights, oh yeah. When they come together, we expect to get a total market capital of how much? Can somebody add this 1218 plus 480? What are we getting here? 1218 plus 480, what are we getting here? Oh yeah. 1218. Wanasema ni 1698. Wanasema ni 1698. Meaning that this will be 1218 divided by 1698. This will be 480 divided by 1698. Sema equals. Please give me figures here very fast. I'm trying to pick. When these companies come together in terms of market capitalization, it will be very important. No, give me this in terms of 0 point. You to put a decimal places Missouri. 0.7173, 0.7173. How about this? How about this? How about the second one? How about the second one? 0.7173. How about the second one? 0.2827. Thank you very much. 2827. Thank you very much. So when these companies come together, I know that the next thing that I will think about is asset beta. I'll have to get this asset beta using Hamada's model. Using Hamada's model, I'll have to look for asset beta. Using Hamada's model for each company. This is not a very good question, but you can still use it to get something. They should not have given you this asset beta. You should have been required to look for asset beta using Hamada's, but here it has been given. I don't know this examiner. So 0.9, 1.2, 0.9, 1.2, right? And then I know out of this process now, ladies and gentlemen, I'll come here and get what we call the weighted average asset beta. So give us the weight. This is the last thing. Weighted average asset beta. Weighted average asset beta. We assume it's not given, eh? Okay. We assume it's not given. But now allow me to finish it. Then very fast, Manoti, I'll be able to come back and then we make that assumption. Because if I'm the one setting the exam, I cannot give you asset beta. I'll leave it at equity beta. I will leave it at equity beta. These guys are asking very good questions like Millicent. I'll be able to answer that. So weighted average beta, oh yeah, even if I don't understand what this means, I'll come and take the weight times this. I'll talk of 0.7173 times 0.9 plus 0.2827 times 1.2 which will end up giving me what figure? Weighted average asset beta. You can't combine equity beta. You can never. The worst mistake you can ever do, as Abdirahman is telling us there, you can't combine equity beta. You can only combine asset beta. So they're telling me I'll also leave No, you can't leave the question. You can't leave. So please give me this figure. Give me this figure. Yeah. So somebody's giving me 0.9848. 0.9848 like that. 0.9848. 0.9848. Is this figure correct? Is this figure agreeable? Yes, thank you very much. So kwanza tuachane hiyo figure kwanza hivyo. Sasa I know, or rather After getting this weighted average asset beta, this is what we call also the beta equity, but of an geared company. Of an geared company. I know after I get this weighted average beta, the next step now will be for me to come here and determine beta equity of the combined entity. You give us beta equity of the combined entity using Hamada's model. Determine beta equity of the combined entity using Hamada's model. We know it offhand. It's beta equity of a levered firm equals beta equity of an levered firm into 1 plus debt over equity into 1 minus tax, like that. All right. So for the combined firm, now we are using this as our BEU, beta equity unlevered. So where I would want to test these guys, the upper debt over equity. That's where I would want to test these guys now. Debt over equity, what do we have there? And the debt over equity, what do we have there? Please apply. No, this board is not very clear. Apply this formula for you to give me the bell. Please try that. Try your best. Okay, so abracadabra, what are they giving us there? These guys of mine. Now wameanza kunyamaza sana. Niliwaambia, iko wanafunzi kutaka kuwasaidia, you can't help them. Because I would want to help them, but most of them, again, they're cowards here. They're almost giving, no, of course you guys are not giving up. You guys are good. You guys shall pass. Great. And you know, those kind of affirmations are very, very important, especially for your inner soul. That you affirm, like you wake up in the morning and you say, I know today will be a great day. That's Monday morning. Today will be a great day, best day, right? I'll get questions that I know, right? I will survive. I will pass, right? Si tunaamuka asubuhi unaona kama ni mtu kuna mashida mingi sana kwa dunia. Unaanza kutembea ni kama umenyeshewa. Hapana, you walk with your head high because the day is going to be good. I shall overcome, yes. That's how you make your affirmations, yes. Those things work. They work. Right? So in this particular question, the BEU, the beta assets, is 0.9848 into 1 plus the debt to equity. Have they given me debt to equity in the question? They've told me in this second last paragraph, the debt to equity ratio of the combined firm will be 4 to 6. So 4 is debt. So 4 here, 6 there. And then we have 1 minus tax. Tax, they've told me tax is 30%. So when tax is 30%, then 1 minus 30%, that gives me 0. What here? Somebody, that gives me 0.7. Is there somebody who was able to fix this thing correctly? Yes, and then this gave you what figure? Thank you so much. So it gave us what figure? Somebody here? It gave us 1 point. Beautiful figure. 1.44444, like that. Now, after getting Bell, what should be the next thing to be done in Hamada's model after getting Bell? What should we do next? Kel. Thank you very much. After getting Bell, give us Kel. After getting Bell, give us Kel. Kel, of course, we use a CAPM. We use CAPM to get Kel. We use CAPM. So CAPM is risk-free rate. plus ERM minus risk-free rate multiplied by Bell. So is there anybody who is able to see risk-free rate? How I wish I was the one setting here. I cannot give you the risk-free rate. If I'm the one setting here, I'll not give you the risk-free rate. Has this examiner given us the risk-free rate of return? Yes, he has given us 2%. Of course, if I don't give you the risk-free rate, you shall use the cost of debt. So this is 2%. How about the market return? Has the examiner given me the market return? It's a great examiner. This is a great examiner. Market return is not 7, Liz. It's not 7. It's premium they have given me. And whenever they give me premium, it means that I should never try to subtract even nothing. It means that I should never try to subtract. It means that I should never try to subtract. So this is what we call the premium. This is what we call the premium, which is 7%. Multiplied by Bell that you guys got here, the beautiful figure, 1.444. And again, now here is where Saturn will visit some students. You'll get a student saying 2% plus 7% is 9%. 9% times 1.444. And then they call you immediately after exam, telling you, Mwalimu, you know what? Come. Ndovu ni kuu. They would want to buy Mwalimu a soda. And then they were not good in body mass. Remember, body mass means that first of all, you multiply it. You multiply 7 and this plus, or you use your calculator directly without saying equals in between. So let's say 2 plus 7 times 1.444. So what are they getting here, somebody? What are they getting here, somebody? If risk-free rate is not given, you always use the cost of debt. And I explained this severally. KD, we use cost of debt simply because debt is secured. You must provide collateral. You must provide collateral. You must provide collateral. So this is 12.108%. So after getting this KPM-KEL, what do you think will be the next thing to be done after getting this KPM-KEL? What do you think will be the next thing to be done? It is the work. What some unprofessional students call workaka. So it is the work. So come here and give us the work. So come here and give us the work. Give us the work. Come here and give us the work. Give us the work. Or WSCC if you don't like calling it work, but never ever shall you call it workaka. So work. So work is weight of equity, cost of equity plus weight of debt, cost of debt, 1 minus tax. So remember here they have given us debt is 4, equity is 6. So out of this, could you kindly give me the weight of debt out of this information? Could you kindly give me the weight of debt? I know what I'll do. I know debt will be debt. Weight of debt will be debt all over debt plus equity. Debt is 4 plus equity of 6, which will be 4 over 10, which gives me 0.4, which gives me 0.4. Thank you so much. Thank you so much. Thank you so much. Thank you so much. And then automatically I get the weight of debt, then the weight of equity will be equal to 1 minus this 0.4, which gives me 0. What here, somebody? Which gives me 0.6 like that. Now we have everything. Ours is to plug in. So our WSCC will be equal to weight of equity. Do we have the weight of equity? Oh, yes, it is 0.6. Do we have the cost of it? Is the KEL, which is 12.108%. Do we have the weight of debt? Oh, yes, weight of debt is 0.4. Do we have the cost of debt? Yes, they gave me 4.55 in the question. In the question, they gave me 4.55. Yes, times 1 minus tax. Tax is 30%. So 1 minus 30%, that gives me 0.7. So my worker will end up giving me what figure? My worker gives me 8.53. 8.53%. 8.53%. I'm so sure I'm pretty fast. I'm so sure I'm pretty fast, but in some way, it could be even a divine way. Are you able to follow? Are you able to follow? Remember, it's not even about you getting everything. It's about you really getting whatever small you can get for purpose of passing this exam, because for sure we shall overcome. We must pass. We must pass. We must pass. Hakuna two ways about this. We must pass. We must pass. The day tomorrow will be a very good day. Even Tuesday will be a very good day. Somebody told me that Tuesday, mambo bad. Sabi tax junior AF. It doesn't matter which papers will be on Tuesday. The day will come, it shall end, and it shall end nicely. Trust you me. It shall end nicely. It shall end nicely. Great. Now from there, we know the last step is about farm valuation. Farm valuation using cash flow. Cash flows. Using cash flows. So farm valuation using cash flows. After we shall use WACC to value the farm. To value, we shall use WACC to value the farm. So could you kindly look for these cash flows for me? Wanasema free cash flows in paragraph number 2 or the first? Saidio mwanafunzi hana timetable. Saidio mwanafunzi hana timetable. Yeah, that's very good. Hana timetable. Mwambie itakuwa siku gani na ni saa ngapi. Siku gani na ni saa ngapi. Hiyo AFM. Kwa mwanafunzi anauliza Tuesday at 9. Tuesday at 9. So if you don't have a timetable, my friend, utaenda tu kwa any center wapie. Please ensure you get your timetable tomorrow. Ensure you get your timetable tomorrow. Unafanya paper aje. Ensure you get your timetable tomorrow. Okay. So come here very fast, ladies and gentlemen, and give us the cash flows. So give us the cash flows. So the cash flows, what do we have here? We have year 1, year 2, year 3, year 4. So free cash flows to the combined company will be 216 million in current value terms. And this will increase by an annual growth rate of 5% for the next 4 years. So we have here 216 times 1.05 raised to 1. 216 times 1.05 raised to power 216 times 1.05 raised to power 3, 216 times 1.05 for the next 4 years. Could you kindly give me these figures? 5%. Remember, 5% is the growth rate. So they have given us there. 5% is the growth rate. According to Paul Macau, we have 226.8. 226.8. 226.8. No, year 1 is not 216. 216 is times 0. 216 is now. 216 is now. Check, it's good you have asked there. We can be a free cash flow to the combined company will be 216 million in current value terms. Current value means what here today. And today's figures are never used in valuation. Today's figures are hot air. Why? Because to value the farm, we are using that free cash flows in the future. In the future, from time 1. Time 0 to me, time 0. Thank you very much. And that is, I want to believe that's a question ambayo imesaidia wanafunzi wengi sana. WACC ya debt ni gani? Tulitumia sio swali lako zilipata vizuri, but kuna ile 4.55 imepeanwa hapo. Umesema cost of debt ile ambayo tumetumia kwa WACC 4.55. Hebu angalia vizuri Alice. Okay, so abracadabra, could you kindly give me the second one now? Even the figures that Paul Macau gave me zimepotea. Please give me the second figure very fast. We have here 238.14. 238.14. From there, we have 216 times 1.05. 216 times 1.05. Macau amenipatia zote. Ameniambia the next one is 250.05. 250.05. And then we have from year number 4. Amesema year number 4 ni 262.05. 262.05. I don't know. 262.55. 262.55. 250.05. 262.55 like that. Now, wamesema hivi, tusome tena. Free cash flows to the combined company will be 216 million in current value terms, and this will increase by an annual growth rate of 5% for the next 4 years, before reverting to an annual growth rate of 2.25% in perpetuity. Yeah, we raised to positive because of what here? In Unaweka minus. Okay. Hello, how about now? Is it a bit better? How about now? Is it a bit better? I'm back now. I'm so sorry. Better. Repeat what you said. Remember, they have told us that a good question there, every year, we expect a growth rate of what percentage? Every year, we expect the figures to grow. The figures to grow by 5%. Assuming, tungoja kidogo. Assuming ungeweka -1 hapa, niambie ingekuwa ngapi? Assuming ungeweka -1, itakuwa less than 216. Itakuwa less than 216. Ungeweka -1, ungeweka -1 niambie. Itakuwa 205, isn't it? Is that the spirit that you guys think that this examiner had in this statement? Is that the spirit really? No. The spirit is about growing. It's about growth rate. And if it's about growth rate, what I've seen some students doing, you can come and get, for example, 216 times. It has to be positive here. If it's growth, it's positive. I know why the confusion, because of what your PVF. You see, PVF is discounting. We are discounting. So we put negatively ndogo as we go to the future. But this is about growing. But I know what you guys love. I'm so sure there must be someone anakuambia ukienda kwa year 2 chukua hii figure ya 226.8 alafu multiply na 1.0, you keep on, you will still get the same answers. You still get the same answers. Can I leave that to you? Muendelea kufanya practice peke yenu. I don't have to really stay here forever. Mtafanya practice peke yenu. Mtaona about growing inafaa kuwa positive. Thank you very much. Now tukuja kwa after end of year 4, now we are talking of infinity. If it's infinity, then we are using a PO formula. And I know PO formula, most of us know how the PO formula behaves like. It is DO into 1 plus G all over. What should I use down here? What should I use down here? WACC, not KE. What's the name? Kwa farm valuation. Kwa farm valuation wewe ni K. Kwa farm valuation natumia KE. Kwa farm valuation tunatumia WACC. Kwa farm valuation tunatumia WACC because the farm, unlike when you're valuing a share, the farm has got both debt and equity. Thank you so much. So abracadabra DO hapa ni 262.55 into 1 plus the perpetual growth rate. Wamesema ni ngapi? What is this perpetual growth rate? The perpetual growth rate ni 2.25, isn't it? So unasema 1 plus 2.25% all over WACC. I remember the figure. WACC ilikuwa ni 12% minus the perpetual growth rate of 2.25%. Hapa lazima uende pole upate numerator na upate denominator. Kando, alafu divide. Unipatie final answer mimi. Kumbuka DO is the most current cash flow. DO is the most current. Hii ni kapem kel. My WACC mnasema ni 8.54. WACC ni 8.54%. WACC ni 8.54%. 8.54%. Hapa enda pole kama Makao na Gordon Ware. Wanasema ni 42.74. Wamesema figa tofauti kidogo. Pata numerator pole, pata denominator pole, divide. And then remember, this is not portfolio management, so you can't ignore the percentage. Tuende pole, tuende mtapata ngapi? Abracadabra. Oh yeah. Ama nimehang ama namna gani? 42.74. Wananiambia mwalimu hapa ni 72, 4274. 4274. We, watu wanafika tofauti 4268. Akiwa watu wanafika tofauti 74 na 68 is the same. 72, 74 na 68 is the same. Natumia 4268. Haya, sasa nisikize. Kutoka hapa usikimbilie mambo ya kudiscount bado. Kutoka hapa kuna column mbili. Unajiuliza synergy benefit. Alafu pia kuna ile concept ya capex. So synergy benefit and capex. Synergy benefit, when they come together, we expect some synergy, yes, present value of cash saved when they come together. When they come together, are you able to see the cash saved there? When I compare the combined operations, paragraph number 3, the combined operations of the companies will result in cash savings of 20 million for the next 4 years. For the next 4 years, is the infinity. Oh yeah, 20 positive. Hapa gotire capex. Watakwambia kwamba after umeshapata cash flows in a particular year, you need to put aside like 30 every year for purposes of our capital expenditure. Right? That we must retain some cash flows. We must retain some cash flows for our capital expenditure. Kwa hiyo question hakuna kitu kama hiyo. Kama ingekuwa oye, ningekuja hapa niseme namna gani somebody hivi. Ningetoanisha hiyo capex na tulewangwa. Alafu sasa tupatie hapa what we call now the free cash flows. The free cash flows. Is there anybody who is able to give me these free cash flows now very fast? The free cash flows. The ones which are free for purpose of valuation. You una add, you una subtract always. You unasema 226.8 plus 20, inakuja 246.8. When pennies the figure, stack of kufikiria sana tafadhali. The page of figures. Naulizeni swali hapa, inakaa mnalemewa kidogo. Mnakumbuka hii kitu ya capex ambao tunatoanga tukifanya farm valuation? Mnakumbuka capex kweli? Mnakumbuka hiyo capex ambao tunatoa? Very important, capital expenditure ambao tunatoa. Ukiambiwa some money has to be retained. Thank you very much. So kutoka hapo nimeambiwa ni 258.14. Ukija hapa J itakuwa 270.05. 270.05. Hapa itakuwa ni 282.55. 282.55. Itabaki 4268 like that. Now you can discount those cash flows to get farm value. Now you can discount them. Go ahead and discount them. Go ahead and discount them. Go ahead and discount this. 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 Go ahead and discount them. So go ahead and discount them. So now the last step, we are discounting them. Discounting cash flows. Cash flows. Discounting cash flows. So we have here 1, 2, 3, 4, and infinity. So we have the free cash flows. The free cash flows. What do we have here? 246.8, 258.14, 270.05, 282.55. We have 426.8. From there, come and give us the famous PVs using the wakaka, using the 8 point something. Nimesahau ilikuwa ngapi? Was it 8.5 something? 8.5 something, 8.5 something, 8.5 something. It was 8.5 something, 8.54%, 8.54%, 8.54%, 8.54%. So mimi najua unajua formula sana woye. Mimi najua unajua formula ya PV ni 1 plus R raised to negative n. Kwa hivyo pata huyo niseme 1.0854, 1.0854, 1.0854, 1.0854. Here infinity stafutangi. Hapa nitasema raised to -1 because now I'm discounting. I am discounting. So could you kindly give me these figures in 4 decimal places? Kindly give me these figures in 4 decimal places. So remember, R is 8.54 divided by 100. Divided by 100. So 4 decimal places, what do we have here? Oh yeah, abracadabra. 4 decimal places, what do we have here? Oh yeah, abracadabra. Wananiambia Liz Kichwen 0.9213. 0.9213. Go to year number 2. Go to year number 2. Year number 2, what do we have here? Year number 2, what do we have here? Year number 2, what do we have? 8488. 8488. 8488. 8488. 8488. 8488. Thank you so much. Go to number 3. You're progressing well. Go to number 3. We are progressing well. Year 3, 7820. 7820. Year 3, 7820. Go to year number 4. Year number 4, what do we have here? Year number 4. 0.72. And I like what Lily is saying there. 72. 0. Amesema for year number 4 and infinity we use the same. Ameshajua. 72 0. So where kuja hapa nipatie column ya mwisho ya present value. Where you are taking this free cash flows times this. Free cash flows times this. 2 decimal places hapa tuenda rakaraka. 2 decimal places hapa tuenda rakaraka jameni. According to Kamau, 226.89. 226.89. So abracadabra, go to the next one. 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 Go to the next one. Abracadabra, go to the next one. Abracadabra, going to the next one. We have 219.11. 219.11. Go to the next one. Go to the next one again. Abracadabra, go to the next one again. Wanasema namna gani? 211.18. 211.18. 211.18. Thank you so much. Tunaenda kwa ya ine. Ya ine, what do we have? 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 203.58. 203.58. And then ya mwisho kabisa itakuwa this figure times this figure. Ambayo inakuja na kuwa ngapi? 3075.09. 3075.09. Unakuja na add, utupatia total present value. Total present value. Utupatia total present value. Total present value. Total present value. Hiyo inakuja na kuwa ngapi? Ukifika hapo ndio farm value, wachana mambo mengine mengi. Hata ni wanafunzi wangapi nafikiri ni Kenya wanaweza pata swali yote? Wanafunzi wangapi ni Kenya wanaweza pata swali yote ukifikiria wewe? Ukifikiria wewe ni wanafunzi wangapi wanaweza kupata swali yote? Wanafunzi wangapi wanaweza pata swali yote 100%? There will be very few, yes. Very few. Hata nyinyi Liz nakubali, lakini the most important thing is that you should be able to pick more than half of the marks. I mean, are there any low-hanging fruits that I can harvest? That is the thing. Ladies and gentlemen, could you kindly give me reasons why mergers fail? Reasons why mergers fail. 3 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 reasons why mergers fail. High, poor synergy, wrong strategy. I like that. Cultural differences, lack of proper communication, poor due diligence. Wewe ulitaka kuoa, umeenda kwa watu msichana hivi hivi, baadaye unakuja kusema sasa ati huyu ametoka kwa familia ya wachawi. Right? Ukufanya due diligence vizuri. Right? Due diligence is very, very important. Right? Yes, this dowry price, the initial valuation, that initial price you'll pay, or the initial valuation, how it was done. If there is an overvaluation, then chances are the parent will end up paying a lot of money to stakeholders who will disappear away very fast. And then at the end of the day, we get ourselves into problems. Yes, poor planning, poor budgeting, I agree that. Integration problems, e.g. cultural differences, excessive optimism. I love this. These have even seen it killing marriages. Unapata msichana from nowhere anasema mimi nikiolewa na Dr. Aura and that is it, and I will never work hard. Who told you? It's only God who can satisfy a human being, not a human being, right? When you have excess optimism, automatically things will do what? Yeah, will go separate, asunder, right? So I think you guys have really, poor management of the integration process. Thank you very much. Thank you very much. Thank you very much. How about this common question that students don't answer very well? This one here of, like the one that came in May 2017. Question number 3A, defensive tactics against hostile takeover. Against hostile takeover, somebody anataka kuchukua cha nguvu, unataka kuolewa cha nguvu. Mnazikumbuka hizo? Yeah, kama poison pill. Thank you very much. Poison pill as a lady. Poison pill, mwambie unajua mimi nikija kwako ujue niko na deni ya Absa Bank ya 10 million. Utanioa na ulipe. Utakuwa unalipa hiyo. Akisikia anajua hiyo ni international disaster. Ya shock repellent clause. Shock repellent clause. Shock repellent clause, also known as what here? The supermajority amendment clause. Amendment clause, yeah. Where in this case here we are saying that for us to be acquired by another company would need approval from like all shareholders. All shareholders. So this young lady is saying that for me to be married, I mean, the gentleman must get approval from every member of my family, including my cousins, my grandmother, grandparents, all of it. That marriage will not happen. That marriage will not happen. That marriage will not happen, right? So we have the white knight. I'm so happy because I can see you guys know this concept. White knight strategy, nimeona mmesema hiyo, white knight strategy, etc. Great. Yeah, disposal of the crown jewel. This is very good. Disposal of the crown jewel. Oh, najua sana maneno. Disposal of the crown jewel. So najiuliza, huyu jamaa amependa nini kwangu? Amependa nini kwangu? Kama amependa nywele, una dispose nywele. Unanyoa zote. Mwanaume akiona kichwa kona 7, anasema hapana. But you see, that is what you wanted, because this is a takeover, which you are considering what here? Somebody hostile. Hostile, yes. So the same case like now Safaricom, somebody is telling us there that Safaricom's jewel is M-Pesa. You dispose M-Pesa. Yeah, counter offers. I can see you guys in this one. You guys are so good. In this one, you guys are so good. Now, what is a horizontal merger? 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 Yeah. So horizontal, thank you very much. Horizontal. We are looking at the coming together of 2 or more entities. 2 or more entities. 2 or more entities which are in the same line of business. Same line of business, same industry, competitors. So we have in this case here, for example, accounting colleges. So we have here, for example, RCM. We have here Summit. So if, for example, if we come together, this will be a horizontal merger where competitors come together like that. Great. Now from there, ladies and gentlemen, we have a vertical merger. Vertical. Yeah. Supply chain, but different what here levels, yes. Different levels. Mergers of suppliers, stroke customers. You can even merge with your suppliers, yes. with your customers, yes. So for example, we have here Toyota. So we have here Toyota and the Michelin tires. We know this is very good for production of vehicles and motor vehicle assembly, right? But of course, they would want some tires. So if, for example, Toyota today was to buy Michelin tires, which has been supplying it, then we talk of what here? Vertical, a vertical merger, a vertical merger, a vertical merger, a vertical merger. Great. How about conglomerate? Conglomerate. Conglomerate. Yeah, so now here we have companies which are what here in different industries. In different industries coming together, conglomerate in different what here industries coming together, different industries, different. So for example, we have here RCM. If RCM, for example, was to work so hard, and then we partner with, for example, Safari Park Hotel, we merge with Safari Park Hotel, Safari Park. You know, these are companies that are in different industries. If we merge, then that will be what here? Conglomerate. And then we have this one here, which confuses some students here. Congeneric. Congeneric. Which one is this? Congeneric. Same industry, but different lines of business. Same industry, but different products. Yes, same industry, but different products. So for example, if RCME, of course, we are in the same line of business with who? With a college like, let me just remember very fast. Utalii College. Utalii College. Utalii College. Of course, both of us, ladies and gentlemen, are seen to be what here in the colleges. But you see, we are offering totally different products. We are producing accountants, and these guys are producing who? You know who they are producing, isn't it? Right? Same industry, but at the end of the day, we have different what here? Lines, different products like that. Then that becomes a generic. Yeah, great, great. I can see somebody giving us a very good example there. I'm interested in this thing. Java versus who? Cake house. This must be a strong one. This must be a strong one. Or RCM with what here? Bookshop, with bookshop. Ah, great. Great. So, ladies and gentlemen,